Most banks deploy their artificial intelligence budget where the win is easiest to see, and that is almost never where the money is. A coding assistant that saves a developer 2 hours a day is visible. You can count the hours, you can put them on a slide, so that is where the budget goes. A fraud model that quietly stops a loss before it happens, or a pricing engine that earns a few more basis points of margin, that value is just as real, but it is harder to see, harder to attribute, and so it quietly gets less of the money. This is the visibility trap. Banks fund what they can watch, not what they can bank, and the gap between the two is now measured in billions. The numbers around banking AI are enormous. The McKinsey Global Institute estimates that generative AI alone could add between $200 billion and $340 billion in annual value to the global banking sector, the equivalent of 9 to 15% of the industry's operating profits. That is the prize. But a prize on a slide is not a number on the profit and loss statement. And when you trace where the money is actually spent against where the return is actually booked, a strategic disconnect appears, and it is wider than most boards assume. By some estimates, banks put more than half of their applied AI budget into back-office efficiency, coding, document handling, internal support. Yet when the returns are audited and traced to a specific line on the ledger, by some estimates, more than 70% of the hard dollar value comes from somewhere else entirely, from avoiding losses and from growing revenue. Those are the two zones a board rarely photographs, and the two where the real dollars truly land. Same institution, same budget, wrong zone. The job of a banking leader is not to spend more on AI, it is to spend it where the return lands. Here is why the back office is so seductive. When an AI tool saves a knowledge worker 30 minutes, that time feels like value. But saved time is not profit, it is freed capacity. And freed capacity becomes money only two ways. The bank redeploys those people onto work that earns more, or it reduces headcount. If neither happens, the saving is absorbed as slack and never reaches the P&L. When a saving has nowhere to go, leaders should not book it as a return. This is the productivity, not profit leak. A bank can run a real measured 20% speed up and see no movement in return on equity at all, because the freed hours were never converted. The trap is built from good intentions. Efficiency is safe, measurable, and does not trigger a regulator, so it attracts the budget. But measurability is not value. The metrics easiest to report, hours saved, calls deflected, are precisely the ones that fail the test of whether a dollar reached the bottom line. What you can count is not always what counts, so make the trap visible. Picture a simple 2x2. The horizontal axis is measurement visibility, how easily a win can be counted. The vertical axis is audited profit and loss value, how much of the return actually traces to the ledger. That gives 4 quadrants. Bottom right is the visibility trap. High visibility, low value, where most of the budget goes. Top left is the gold vault, high value, low visibility, where most of the audited return lives, underfunded because it is harder to see. Top right is the proven win, high on both. Fund these first. Bottom left, the quiet drain, low on both. Most banks pour capital into the trap and starve the vault. The whole game is to move the money diagonally out of the trap into the vault. To move the money, you need a map of where value lands. Every banking AI use case falls into one of 3 value zones. Zone 1 is run the bank, cost out. Operational efficiency, software engineering, back office automation. Its metric is operating expense reduction. This is the home of the visibility trap. It commands the budget, but the value leaks unless capacity is genuinely redeployed or removed. Zone 2 is risk intelligence, loss avoidance, fraud detection, anti-money laundering triage, early warning credit risk, compliance. Its metric is losses avoided and provisions reduced. And on the evidence, this is the highest risk-adjusted return per dollar of AI spend in the entire bank. When a model blocks a fraudulent transaction, the value hits the ledger immediately, near zero latency. And it sits inside mature, well-understood risk frameworks, so it carries far less regulatory danger. Zone 3 is grow the bank, revenue, acquisition, cross-sell, dynamic pricing, personalized advice. Its metric is net interest and non-interest income. It has the highest ceiling of all and the heaviest regulatory load, because the moment AI touches who gets a loan and on what terms, fair lending law is watching. Get it right, and the upside compounds. Get it wrong, and it goes straight to the regulator. So the rule writes itself. When the budget sits in Zone 1, leaders should reallocate toward the loss avoidance premium of Zone 2 and pursue Zone 3's revenue carefully, with the governance built in from the start. Safety and growth are not opposites here. The bank that reallocates by audited value, not by ease of measurement, wins in the end. The evidence is on the ledger of the banks already doing this. Take the heaviest technology investor in the industry. It reportedly spends about $2 billion a year on AI and recovers about the same, but roughly $1.5 billion of that return comes from fraud prevention, trading, and operational risk efficiencies. That is Zone 2 doing the heavy lifting, not the back-office co-pilot everyone photographs for the board deck. A leading Asian bank reportedly booked about 1 billion Singapore dollars of economic value from AI, measured against control groups, not vague forecasts, driven heavily by Zone 3 personalized engagement, where customers who used its AI guidance invested several times more. Same lesson, opposite corner of the map. The return lands where the loss never happened or where the relationship deepened. And the cost of getting Zone 3 wrong is just as real. A United States student loan lender, Earnest, paid a $2.5 million settlement to the Massachusetts Attorney General over an AI underwriting model that produced disparate outcomes for protected groups. Revenue AI without governance is not value, it is liability, and the heaviest regulatory load sits on the zone with the highest ceiling. The macro picture sharpens the point. Gartner projects that more than 40% of agentic AI projects will be canceled by the end of 2027, most of them for failing exactly this value test. And the supervisory ground is shifting. Revised model risk guidance now scales by risk rather than size and pushes generative and agentic systems onto the enterprise to govern. The institutions banking real value are the ones that move their money by zone, not by demo. So here is what to do on Monday. Run the loop. First, tag every AI use case to one value zone and one profit and loss line, and let no initiative call productivity its outcome. Second, trace your spend per zone against your audited return per zone, and watch the disconnect appear in your own numbers. Third, reallocate, moving marginal capital out of the trap and into the premium. Fourth, guard the gain, matching your governance to each zone's risk. A light gate for Zone 1, an audit trail for Zone 2, full guardrails for Zone 3. Stop funding what you can see. Start funding what you can bank. Turn AI into real business value at AI Business Architect New Analysis every week. If this changed how you see AI value, subscribe.